My name is Dina Prodinaya and my metric number is 288889, and I'll be starting off by presenting my part, which is the summary based on the MFRS that we have chosen, which is the fair value measurement. Fair value measurement, which is the MFRS 13, defines fair value that focus on assets and liabilities as they are the primary subject of accounting measurement. Financial reporting standards, which is issued specifically by the Financial Accounting Standards Board, they define fair value accounting as funds raised from the sale of capital or paid through the transfer of debt in an orderly transaction between market participants at the measurement date. Fair value is a market-based valuation and it is not company-specific valuation. Observable market transactions or market information may be available or not available, like for certain assets and liabilities. However, the purpose of the fair value measurement in that both cases is actually the same, which is to estimate the price at which market participants would sell an asset or transfer a liability in an orderly transaction on the measurement date under the current market conditions. We have decided to option for MFRS 13 as to evaluate the compliance with the accounting standards. And by complying with the MFRS 13, companies also can ensure that their financial statements comply with the regulatory requirements. This includes like the consistency and also the comparability is done for further knowledge, where since MFRS 13 they provide a framework for consistent measurement of fair value. So this consistency actually improves the comparability across the companies and as well as the industries. Also, this case study is done no more on the transparency and also the accuracy. Since fair value measurement are designed to reflect the current market value of the assets and liabilities, so this actually helps to increase the transparency of the financial reporting and also provides the users of financial statements with a more accurate and relevant information about the company's financial position. So firstly will be the theory of positive accounting. As you can see, the goal of positive accounting is to forecast and explain real-world accounting procedures. For example, if like the executive compensation is tied like to the market value of the firm's assets, so there may be like an incentive from the management to prefer the fair value measurement. This is because the fair value often reflects current market prices and is perceived as the more objective kind of a measure. Positive accounting theory also considers information asymmetry between the different groups of stakeholders, where fair value measurement, when used appropriately, they can provide a timely and relevant information to the market. So managers may choose the fair value as a signaling mechanism to convey the true economic value of the company's assets and liability. The next one is the theory of normative accounting. So normative theories are established as the guidelines for the accounting procedures, where their focus actually lies on developing a collection of guidelines or standards that specify optimal accounting procedures. So normative theories are deductive theories that begin with a certain goal, assumptions, and derive accounting procedures from them. So a normative theory can be exists of two key components, which is the goal assumption and as well as deduction. This is relevant to the MFRS 13 that is seen as a morally and ethically good. While fair value is more associated with a market-oriented and unbiased approach, there are actually situations where normative theories advocate with tempering fair value with prudence. So the concept of conservatism is a crucial aspect of the accounting that can be defined as a pervasive principle of accounting valuation. Especially, this principle involves selecting accounting policies that determine most appropriate terms and amounts of recognition of the effects of certain business transactions to prevent any artificial increase in the assets and profit when these amounts are actually uncertain. The third one is the theory of agency, where we know the theory of agency is a significant concept in accounting and finance that explores the relationship between the principals, such as shareholders, and agents, such as the managements. So one of the key elements of the agency theory is the information asymmetry, where managers often have more information than the shareholders. Fair value measurement may be viewed in an incorporate market-based risk assessment for the financial reporting. This is particularly relevant when assessing the risk associated with certain financial instruments or investment. So its goal is to let the users, which is the principals, assess agents' performance and make well-informed decisions, judgments based on the information about the fair value.
Next, I will be presenting on the main parties involved in the development of Fair Value Measurement MFRS 13. The Malaysian Accounting Standard Board MASB was the one who developed MFRS 13. MASB follows a due process in setting the accounting standard of MFRS framework to align with the IASB's due process timeline so that they can put the new or amended standards in place for adoption and application within a timely manner. MASB established a working group called WG61 with the responsibility to discuss and develop the working paper on MFRS 13. The working group consists of representatives from the Securities Commission Malaysia (SC), the Malaysian Institute of Accountants (MIA), and Bank Negara Malaysia. The Financial Reporting Foundation (FRF) serves as a sounding board and is obligated to provide the MASB with the preliminary feedback on proposed pronouncements and standards. Other than the professional bodies, the industry players and academia also play important roles in the development of MFRS 13 as they were not excluded from giving feedback on the exposure draft. That's all from me. Thank you.
Assalamualaikum and hi, my name is Nur Afni Hidayati binti Abdul Rahman. My metric number is 287920. Today I would like to present about the nature of MFRS 13, Fair Value Measurement. MFRS 13 defines fair value and offers a framework for figuring out how much assets and liabilities are worth. It aims to improve financial reporting uniformity, transparency, and comparability by providing a set of uniform requirements for fair value measures across all IFRS standards. MFRS 13 is a principle-based accounting standard because it provides a framework as opposed to a set of exact regulations. Rule-based standards contain predefined norms that must be followed when preparing financial statements. According to Vincent in 2003, the principle-based approach enhances international convergence with accounting standards and streamlines the production of financial statements. The main benefit of principle-based approach is wide guidelines and useful applicability in a range of situations. However, there are drawbacks as well because there are not as many stringent guidelines and limitations as there are with rule-based standards, including the problem of conflicting data and challenges when comparing multiple organizations. Supervisors may determine how crucial a piece of information is to the organization's operations and then modify the statement to fit the necessary passage of a standard. As a result, following the arrival at an agreement with the auditors, it can only result in the withholding of information that was stated in a typical way.
Hi, my name is Noriza binti Kamarul Zaman, metric number 288610. So I'll be presenting about the limitation of MFRS 13 fair value measurement. There are 4 challenges that are associated with the application of MFRS 13. First, lack of evolving market for assets and liabilities. In the definition of IFRS 13, which the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction implies the need to use an exit price. However, the exit price might not be easily accessible. A larger number of comparable transactions, active trading platforms, and the availability of reliable market data make it simpler to determine fair value in a country. Conversely, market participants find it challenging to implement fair value rules in emerging economies when those features are absent. They are forced to use another alternative method of valuing as a result, which might introduce subjectivity and complexity. Second, the structure of capital market itself make it difficult in determining the fair value. Determination of fair valuation is not affected by an entity's intention to retain an asset, settle or fulfill the other obligation. A valuation method could be used if the transaction is not immediately visible in the market. There are three valuation techniques that provided by IFRS 13 could be used in determining the fair value, which are market approach, income approach, and cost approach. Next, subjectivity in assessing fair value and manipulating estimates. Estimating the fair value of an asset may involve different levels of subjectivity depending on whether there is a market for the asset and liabilities in issue. Fair value allows judgment and requires a high degree of professional judgment in the audit of valuation process utilizing level 2 and level 3 data. Because of this, it could be necessary to estimate the price of commodities for which there is no easily available market information using judgment. MFRS 13 classifies input into three levels, which is level 1, level 2, and level 3. Level 3 representing unobservable inputs. It may be more subjective and need more judgment because there may be little or no market data available. Estimates of fair value can be manipulated because of the subjectivity in the process. Lastly, lack of knowledge about fair value of accounting will also become challenging in implementing MFRS 13 because it can lead to variation in fair value estimates. It also suggests that companies are either unaware of changes to fair value assessing technique or are not receiving regular updates. It is essential that financial professionals participate in ongoing education to ensure that they have the most recent information. To overcome these challenges, financial professionals must actively engage in continuing education. This means attending relevant training sessions, participating in industry conferences, and staying up to date on the latest developments in fair value accounting.
Based on the limitations that have been described by the presenter Iza, here are some ideas and suggestions to deal with the challenges related to the implementation of MFRS 13. For the first problem, the company can use external valuation experts to determine the fair value and comply with MFRS 13. These professionals calculate the exit price using various approaches. Management should provide clear instructions to valuation experts for financial reporting. The process includes identifying items, units of account characteristic of assets and liabilities, marketability, and alternative use of assets. Important factors include assets attributes, market accessibility, MFRS 3 criteria and quantitative evidence, transparent communication and addressing of unit of account issues, and MFRS 13 compliance are essential for accurate fair value measurement in financial reporting. Next, organization can use various valuation techniques including MFRS 13 fair value measurement, the prior transaction method, implicit multiples, discounted cash flow, and comparative company analysis. These methods aim to accurately reflect the characteristic of an asset or liability considered by market participants. The prior transaction method examines previous transactions for similar assets or companies, particularly when there is no active market, while implied multiples require entities to modify multiple transactions to account for a discount of 50% or more on the acquisition. Due to the acquisition of a small number of shares, publicly traded companies are exempt from the lack of control discount. The exposure index measures the sensitivity of fair value estimate to changes in unobservable input variables. In summary, depending on the type of asset or liability and the accessibility of market data, organizations can select from a range of alternative valuation methodologies. Every approach has advantages and disadvantages, and the best option frequently depends on the particulars of the valuation. Next suggestion is to enhance transparency and disclosure. The study by Song, Thomas and Yee 2010 highlights the need for transparency in fair value hierarchy disclosures in US Bank following SFAS 157 adoption. Investors set different valuation coefficients based on hierarchy level, and level 3 measurements require extensive exposure for reliability. Synthetic credit ratings can assess credit quality and changes in leveraged loan index spreads, providing investors with better understanding and confidence in reported fair values. Last but not least, hold an educational campaign. One way to promote fair value accounting to countries with low awareness is through various platforms such as webinars, workshops, seminars, and educational materials. The company intends to initiate an educational campaign aimed at various stakeholders, including financial professionals, auditors, financial statements, provisions, regulators, and educators through the use of multifaceted and multi-channel strategy to ensure that future professionals are exposed to fair value accounting principles. It will also work with educational institutions to integrate these ideas into the accounting and finance curriculum. Not only that, but the goal of the educational campaign is also to produce and disseminate easily understandable materials such as manuals, guides, and brochures that explain the principles of fair value accounting so that the public can fully understand this idea.